Hello and welcome back to Chapter 1. Today we're going to learn about the elements of the financial statements that are within this conceptual framework. Conceptual framework. It's described as the accounting constitution and provides the foundation for U.S. accounting standards. It tells us which transactions and events are accounted for, how to measure those transactions, and how to best summarize and communicate the information to users. And all of this is provided by the FASB through the Statements of Financial Accounting Concepts. Just to review quickly what we've learned in the previous video is that the objective of financial reporting is to provide financial information that is useful to capital providers in making decisions. And we do that through the conceptual framework, which is made up of qualitative characteristics, elements of the financial statements, and recognition, measurement, and disclosure concepts. In our previous video, we learned about the qualitative characteristics, and in this video, we're going to learn about the elements of the financial statements. Here you can see where elements fall within the conceptual framework. Elements are grouped based on their classification within the financial statements. The assets, liabilities, and equity are part of the balance sheet. The investment by owners and distribution to owners are make up part of the equity section, which, as we said before, is the balance sheet. Revenues, expenses, gains, and losses make up the income statement. And comprehensive income, while sometimes considered its own statement, ultimately feeds into accumulated other comprehensive income within the equity section of the balance sheet. We'll start with elements, starting with the balance sheet. First is assets. Assets are resources a company controls that provide current and future benefits. The ownership is not a requirement, but control is a key factor. For example, a company may use a building it does not fully own due to a mortgage, but as long as it can utilize that property in a way that it sees fit, it will qualify as an asset. An asset must provide future benefit due to a past transaction. Businesses operate under the assumption that they will continue indefinitely, which is why future benefits are considered essential. Common examples of assets include cash, inventory, property, plant, equipment, and intangible assets, such as patents or trademarks. Liabilities are obligations requiring a future sacrifice of assets, typically cash. These represent debts incurred due to a past transaction, and they do require repayment in the future. A loan, for example, creates an obligation that must be settled over time. Examples of liabilities include accounts payable, loans, notes payable, and accrued expenses. Accounts payable arise when a company purchases inventory on credit and must pay later. Accrued liabilities represent expenses that have been incurred but not yet paid. Equity, also referred to as net assets or net worth, is the residual interest in a company after liabilities are deducted from assets. This concept is similar to net worth for individuals. Equity is calculated by subtracting liabilities from total assets. If a company liquidates and pays off all its liabilities, whatever remains is the equity. A positive equity balance indicates financial stability, suggesting the company retains value beyond its debts. Another important element of financial statement is the investment by owners, which refers to the transfer of assets, usually cash, but can be other forms, by investors, owners, or shareholders to the business entity. When an investor contributes funds, the company assets increase, leading to a corresponding rise in equity. If a business receives an investment, its total assets grow while liabilities remain unchanged, resulting in a higher equity. On the other hand, distributions to owners represent the withdrawal of assets by shareholders. These transactions reduce the equity. If an owner withdraws funds from the business, assets decrease and equity is adjusted accordingly. So investment by owners and distributions to owners operate as opposites. One increases equity and the other one decreases equity. Moving on to the income statement, revenues reflect an increase in assets or a reduction in liabilities, often occurring when a company provides goods or services. Businesses generate revenue through various activities such as selling products or offering services. A key component differentiating revenues from gains is that revenues are generated from the company's ongoing central business operation, meaning the revenue is resulting from the core operation of what that business is intended to do, such as a university earns tuition revenue, or a company like Google generates advertising revenue. That is considered revenue for those companies. Again, gains are similar to revenues in that they do increase, it's an increase in asset or reduction liabilities resulting from a transaction, but these are peripheral or incidental transactions of an entity, meaning these are outside the company's main business operations, such as if McDonald's, whose main business operation is selling fast food, sells an assets for more than its original cost, they will record a gain rather than revenue because it's outside their normal course of business operations. Expenses are the exact opposite of revenue in that it represents a decrease in assets or an increase in liabilities due to costs incurred while operating a business. They are similar to revenues in that those costs that we incur are part of the company's ongoing central operations. Losses are similar to expenses in that they are decreases in assets or increases in liabilities due to costs incurred, but these costs are incurred from peripheral or incidental transactions of an entity. For example, expenses, which are part of the daily operations of an entity, include utilities, rent, wages, and inventory. A loss, back to the similar example from the previous slide, if McDonald's, which their central ongoing operations are selling fast food, sells a building and they sell it for, they receive less money than what it cost, they would record a loss, not an expense, although both are decreases to net income. So we learned that net income results from a combination of revenues, expenses, gains, and losses. Alternatively, comprehensive income includes all changes in equity except those resulting from owner transactions, such as investment by the owner or distribution to the owners. Examples of comprehensive income components include unrealized gains and losses on hedge derivatives, financial instruments, or foreign currency transactions. We will learn more about those types of transactions later in the year. These gains and losses do not appear on the income statement, but still affect equity. And since these adjustments can significantly impact the financial positioning, they are reported in comprehensive income rather than net income. Comprehensive income is eventually transferred to equity on the balance sheet rather than being included in the standard income statement calculations.